All right, so we're gonna focus now on VAT. Many students find this topic a little bit tricky, especially if they have to do with the general ledger account. So what we're gonna be doing now, we're going to focus on how do you prepare general ledger accounts for VAT based on information that is provided. So if you're going to prepare a general ledger account like the VAT account, the input VAT account, or the output VAT account, then you need to know the original journals, right? In the original journal entries, when you look at your sales journal, your purchases journal, there's always a VAT column there. That is to say, if VAT is included. So you need to know the nature of the transaction. Where does that VAT come from? Right, so what I'm going to do now is that I'm going to look at these journals and try to explain to you where the VAT comes from, right? So we start with our cash receipts journal. So with our cash receipts journal, cash receipts means we are receiving cash, right? So how do we get VAT output when we are receiving cash? So you need to remember that this is going to be a cash sale, right? If we make a sale on cash and we receive the payment and we deliver the goods, then we're gonna record VAT output from the cash sale. Remember that if it is a sale on credit, then it won't be recorded on the cash receipts, but in the sales journal. Right. So this is going to be VAT output that we recorded from making our sales on credit, but this is a sale on cash. Right. So the VAT output here is a sale on cash, which means that when we recorded that sale, right, we had to debit bank because we received cash. Then we have to credit our sales, then we have to credit our VAT output. So in this case, we only given the VAT output portion, right? We need to remember that the debit entry was in the bank account. So that's very important to understand where the transaction comes from. What are the other contra entries, or what is the other leg of the transaction that was either debited or credited? So if you look at VAT input in a cash receipts journal, to say we are receiving cash and then we have an expense from receiving cash, right? And so that expense is the settlement discount granted. To say we allowed a customer to pay less and then we had an expense called a settlement discount granted. So the VAT input for that settlement discount granted is this much. So when this was recorded, remember that we did debit the trade, we did debit bank, right? Sorry, not bank. Sorry, yeah, we did debit bank. Then we debit the settlement discount granted. Then we credit the trade receivables control. So you need to remember the original transaction and how the VAT gets involved. So if you look at your cash payments journal, the VAT input in your cash payments journal, right, means that we are paying cash. So these are cash purchases, right? So the VAT portion of the cash purchases is here. If we buy on credit, then it's going to be in the purchases journal, right? And it's going to be the VAT input, right? So if it is in the cash payments journal, then it means that it was a cash purchase. And then the VAT output means that we received some income or some benefit from our making payments. We were making payments and we received a benefit. So this is a benefit from the settlement discount received. Right. So you remember that then we are going to debit the trade payables. We're going to credit bank. We're going to credit VAT output. We're going to credit settlement discount what received. Okay, like that. Right, so that's how we deal with this VAT. So if it comes to purchases returns journal, remember purchases returns is a reversal of the purchases journal. Sales returns is a reversal of the sales journal. So this is going to be VAT output that is being reversed. This is going to be VAT input that is being reversed. Right. So if you want to think in terms of so if I can just delete everything here so that we can make it clean in front of us. Right, so this is going to be in your VAT input, right? So it's going to be in your VAT input. And the description is going to be because we're going to if they from a cash receipts journal, if we have VAT input, it means it's settlement discount granted, then it's VAT input, then it's bank, right? And as well as trade receivables control, because it's a customer who paid. So the account to credit is the trade receivables control. The account to debit, these are the accounts to debit, right? Okay. Now, if you're going to put a debit entry in your VAT input, the description will be the account that was credited. All right. So the description here under this VAT input would be trade receivables control, because that's the account that was credited in the double entry. These are debit, we debit this, we debit that, we debit that. But then we have to credit the trade receivables control. So when you prepare your VAT input, you're going to have trade receivables control, and you're going to have 4,600, like that. And so if we're going to start with the trade receivables control, no. If the VAT input account only, then we have another VAT input here, and this is from the cash payments journal. So the cash payments journal is when we pay on cash. So it means that we're going to debit the VAT input, but the amount, the account to credit is going to be your bank, because this was a payment that was made. So we're going to debit here purchases. We're going to debit VAT input. Then we're going to credit the bank because it was a payment that was made. So when we record this in the VAT input account, we reference the other leg of the transaction. The double entry is that we debited VAT input, we credited bank. So 126,500 will come here as bank. That is to say, this is the account that was credited. Yeah, that was credited. Then we come to a purchases journal. We know that a purchases journal is going to be VAT input in a purchases journal, right? And so what happens is that we bought on credit. So we're going to debit VAT. We're going to debit trade. We're going to debit VAT. We're going to debit purchases, right? Then we're going to credit trade payables control. So trade payables control is the other leg of the transaction. So we have to put in the amount of VAT there where the credit entry of the transaction was recorded in the trade payables control. So if you want me to repeat this purchases journal, we're saying that we made some purchases on credit and the VAT input there was 75,900. So in this case, the examiner didn't give you the The examiner didn't tell you whether it's VAT input or output. They just said VAT. So you should know that for purchases, in the purchases journal, it's always VAT input. In the sales journal, it's always VAT output. Right? It's something that you must know. Right? So what happens is that when we bought something on credit, so this is the VAT input, and then we're gonna debit VAT input. We also debit the purchases, but because we didn't pay, we're gonna credit trade payables control. So the trade payables control is this amount that you enter here. Then we look for another VAT input, and the other VAT input is going to be here in the, what is this? Purchases journal. So the purchases journal is a reversal. All right. So we originally recorded the VAT input, but we are now reversing that. All right. So this will be also under trade payables control, but it's on the credit side because we are reversing this 9,200. 9,200, right? Right. So eventually, that's how we get to record this information in the VAT input or VAT output. Basically, we need to know, right, how does the transaction arise so that we could end up having a VAT input in the cash receipts journal, VAT input in the cash payments journal. We need to know how the transaction arose. So one trick that you need to remember then is that whatever you're doing, if it is a VAT input account that you have to construct, there are certain things you have to commit to memory, right? For example, at the beginning of the period, you're going to have a balance, all right, brought down. You don't care the amount here. So this is just the structure of a VAT input. Then a trade receivables control coming from the cash receipts journal, then bank, and it's the cash payments journal, then trade payables control, and it's the purchases journal. Then on this side, trade payables control and the purchases returns journal. So you need to structure your VAT input like this. It's always going to be like this. So as you prepare to go to your assessment, for example, you can just have your VAT input and you have this balance and you know that it's a brought down. Then you know that there is going to be trade receivables control from the cash receipts journal, bank, from the cash payments journal, trade payables, from the purchases journal, right? So once you enter these and that, you probably have over maybe 50% of the marks already. And before you even start entering the actual amounts, you have the correct structure. So this will be the balance brought down. This 4,600 is what we have in the cash receipts journal, right? Remember that. So our cash receipts journal told us that so our cash receipts journal told us that we had VAT input of 4,600. So that's why we entered it here. So we did enter that 4,600 under trade receivables control because it's the customer who was paying and we gave the customer a discount. So that's going to affect our trade receivables control. That is the account that was credited, right? And you remember that we also have a VAT input here from the cash payments. So we're gonna put that under bank because we were making a payment. Then you remember that we also have purchases journal, right, on credit. So this is going to be VAT input, right? And your purchases returns is going to be VAT input again, but it's a reversal. So that's 9,200 is going to be on this side. So if you are supposed to transfer this balance to the, what is this thing? to the VAT control, then you're going to use your general journal, right? The balancing figure is going to be transferred to the VAT control. But sometimes, if you're not going to pay your tax, your VAT yet, then you will have your balance brought down instead. Right? And then this will also be your balance. No, this will be a balance carried down. Then there is going to be a balance brought down. All right. That is to say, if we are not closing off to the VAT control account so that we can pay VAT, before that, at the end of the month, if that's not the month we have to pay VAT, then we have a balance brought down. But if you have to pay VAT that month, then we have to close off everything to the VAT control. Right. So basically you have to, so if you come across a question like this, it should be easy. First of all, just drag and drop your balance brought down because you know it's a VAT input. You start with the name of the entity, General Spatzer Shop. It's a general ledger. This is VAT input, so you drag and drop. This is balance because your VAT input is, you could say it's an asset. It's going to be on the debit side. So your balance brought down, you drag drop. Trade receivables control, CRJ, you drag drop. Right, so that is exactly what you will do. Then if it comes to the VAT output, we have one here. So if we're going to construct the VAT output, so the balance brought down obviously will be here because your VAT output is considered to be a what? A liability, right? So your balance brought down will be here, right? This is VAT output that coming from the cash receipts journal. So that will be cash sales. So that will be bank, right? So we say it's bank because if I can explain we made sales and received payment, right? So we're going to debit bank for the amount received, right? Then we're going to credit sales. We're going to credit VAT output, all right? So when you record this under the VAT output, you have to mention the other account that you debited. So we're going to put this under a credit on the credit side of the VAT output, this amount. And then we have to mention the account that was debited. So that's why we say it's bank here. So that's the contra account. All right, so I will also show you how to do the same thing with VAT output as we do with VAT input, memorizing the structure. Right, here is another VAT output here. So this VAT output, as you can see, it comes from the cash payments journal. So it means that we got a benefit when we were making a payment, right? So obviously that's a settlement discount received. And settlement discount received is coming from the trade payables. So we're gonna put it under trade payables control. So if you want to confirm that when we make payment, we're going to credit bank. All right. If there is settlement discount received, then we're going to credit the settlement discount received, right? And then we're going to also credit the VAT output. So these are amounts that are we going to credit. Then we're going to debit the trade payables control with the full amount we are going to clear. So this amount, this VAT output account is being credited. We need to write the description of the account that is being debited. That's why we say trade payables control, right? And so the examiners expect you to be able to pick these things up from just looking at a journal entry. You should remember, where is that coming from? So we are under VAT output. Then the sales journal will have VAT output. So that's your trade receivables control, right? Which is 144,900. Then we have sales returns journal, which is also trade receivables control, and it's a reversal like that. So basically that's how you construct this. So if you go to the example that we have the name of the entity, then general ledger, then VAT. Your balance is always here. So this is the bank entry. Remember that where we say Cash, there's cash in the cash receipts journal, there's VAT output. Where does it come from? From cash sales. Cash sales are received in the bank. That's why we have the bank as the account that was debited. Then trade payables control, it means we received a benefit from the suppliers. So this is the, when we made payment, we received settlement discount received. Then there was VAT output in that settlement discount received. So we calculated VAT output, we put it separately, right? Then this is your sales on credit, right? The VAT based on the sales on credit. They're going to affect your trade receivables control. This is the sales returns. So when you deal with your VAT output account, it also has a structure. Before you even start, you can drag and drop and get about 50% of the marks, right? Because with your VAT output, you know that the balance is going to be on the credit side, not so. So it's a balance brought down. Then there's a bank CRJ. Then there's trade payables control CPJ, trade receivables control sales journal. Then you need to remember that this benefit from the bank means we sold on, we might have, we sold on what? On cash. It's a sales made on cash. Trade payables control means it's a benefit we received when making payment. This is sales that were made on credit. And this is the VAT. And this is their reversal. So you drag and drop this and that, that and that, this and that. Then you have about 50% of the marks already. And then you start calculating the amounts. In this case, it's easy because the VAT amounts are directly given to us. All right. So I'll give you an example of a sales journal here. So let's say this is a sales journal, right? So I'm trying to make it a sales journal. So we have a trade receivables column, we have a sales column, we have a VAT output column. All right. So if this is going to be 115,000, you should be able to know how much is the VAT output, because you know that trade receivables control is recorded inclusive of VAT. So sometimes they will give you the, under the sales journal, they won't give you the actual VAT output. They will give you the amount under trade receivables control. And you as the student, you need to remember that trade receivables control is recorded inclusive of a VAT. So you're gonna say 15 over 115 multiplied by 115, right? Then you already, now you get your VAT output that you need to put. So we'll give you information, but do not tell you how much was the VAT. Or what they could do, instead of giving you trade receivables control, they could give you that under the sales journal, the sales was 100,000. And you need to know that sales is recorded exclusive of VAT. Then how much was the VAT? Then you have to come and say 15% multiplied by 100,000. Then you know that that's going to be 15,000, right? So sometimes they give you the 15,000 here, and they need you to be able to understand which account, or what was the nature of the transaction, how is the double entry done. So they could give you a sales journal and give you any of these amounts, right? And you have to get the rest from manipulating. Okay. All right, so in this particular case, they were very soft, all right, because they actually gave us the actual VAT amount. So a different scenario is this one. Where is it? This one, which I was talking about just now, where they will give you not the VAT, but related amounts. So under the cash receipts journal, right, they gave us the VAT input column. And like we said, remember that this is settlement discount granted. This is the VAT portion for the settlement discount granted. Because when the customer was paying, we received the money, we gave VAT. We gave settlement discount to the customer. And now under the sales column, So under your cash receipts journal, there is a sales column, right? It's 153,500. So we're still dealing with the cash receipts journal, right? So in the cash receipts journal, there will be a column for VAT input. There will be a column for sales as well. So you need to remember that this amount under sales is recorded exclusive of VAT. So therefore, the VAT output is going to be 15% of 153,500, right? So you need to remember that. And you remember that under cash receipts journal, it's actually cash that was received for sales. So this is cash sales. So the journal entries where we debit bank, we credit sales, we credit VAT output, like that. So when we go to the VAT output account, then we're gonna put a credit entry of 15% of this amount, right? Then the description is bank, because the bank account is the account that was actually debited in the transaction, right? So you see that there are a few tricks there which the examiners can use, right? So if you want your VAT output here, it's going to be 15%, and the description is going to be bank, right? And if you want here, this is settlement discount granted, right? And the description here will be trade receivables control, right? Because that's the account that was credited. So this is VAT input. This will be VAT output. The amount related to this column will be VAT output. Then we come to the cash payments journal. So we made payment. So the purchases column is this amount. So you remember this is going to be VAT input because we are making a purchase. But the purchases column will be recorded exclusive of VAT, right? So the actual VAT input is 15% multiplied by 221,900. And the description will be bank, right? Because it's a payment that was made under cash payments. So this is the purchases column, all right? Right. So we remember that the purchases column is exclusive of VAT. That's why we have to add VAT on top. Then under the cash payments journal, we received a benefit because VAT output pertains to the benefits that we received, for which we are being charged by. We're being charged by SARS to pay over to SARS, right? We have to levy VAT output to the customer. So this is coming from settlement discount received. Right. So the account that was affected, remember that we have to say we are making payment to a creditor or to a supplier, then we're gonna, because a supplier is a liability, trade payables is a liability. If we make payment, we are reducing the liability. So we have to debit trade payables control, and then we credit bank. Then we credit settlement discount received. We credit VAT output. So if you go to your VAT output and you make an entry of 1680 on the credit side, the description will be trade payables control, right? Because that's the account that we debited, right? I hope that does make sense to you. Right, so let me just write this so that it's clear. So we said, what did we say here? Cash receipts, so this is settlement discount granted, and the description is trade receivables control. It's VAT input. Sales column, it's obviously sales, right? Cash sales. And the description there is going to be bank, right? Because this was received. This is VAT output. And it's going to be 15% of that. Then under cash payments, purchases column, it's going to be VAT input. It's going to be 15% of that. These are cash purchases. And the description will be bank. Right? Because that's what we, the amount that was credited. Then under the VAT output, this is the settlement discount received. Right, and like we've demonstrated just now, it's going to be obviously VAT output, and it's okay as it is. And the description is going to be your trade payables control, because we were making payment and we received a benefit for which we are being charged VAT. Right, so under the purchases journal, right, you remember that the trade payables column is inclusive of VAT. So your VAT will be 15 over 115 multiplied by 152,950, because that's inclusive. So this is going to be VAT input, and the description is going to be trade payables control. Right. In the sales journal, the trade receivables column is inclusive as well. Right. Times this amount. And the description will obviously, so this is VAT output, this is VAT input. And the description is going to be trade receivables control, because we make sales on credit, we debit the trade receivables control, we credit sales, we credit VAT output. Then purchase returns journal, this is going to be VAT input, but it's a reversal. Right, it's a reversal of the VAT input. And the trade payables column is inclusive, so it's going to be 15 over 115. This is VAT input. The same applies to the sales returns. The trade receivables column VAT output that is being reversed, and the trade receivables column is inclusive of VAT. Right. So eventually you take all those amounts for VAT output and you're going to put them there. So these are the opening balances, which are not important. So like I said to you, when you deal with your VAT input, the first luck thing you do to yourself is to drag and drop the entity name, the general ledger, then VAT input, you start with you drag your balance, brought down, you drop it, you drag your trade receivables control, put it there, bank, CPJ, this, that, then you're done. Then you can look for which amounts was the balance. And the trade receivables control under the CRJ, we did calculate. All right, so this was what is this? This was the settlement discount granted, right? Then this was the cash purchases. This was the credit purchases. This is the purchases returns. And like I said, if we are closing off to the VAT control, then we use the VAT control and the general journal. But if we have to pay VAT the following month, then we have to say balance carried down here and the balance brought down here. If you come to your VAT output, you are a lucky person because you start by dragging your balance brought down on the credit side, trade payables control, CPJ, bank, CRJ, trade receivables control, sales journal, trade receivables control, sales returns journal. Right, so you have got about 50% of the marks by dragging and dropping correctly, because the structure is not going to differ. It's going to differ. Let's say we are not given this particular column, this particular information, then we're going to leave it out. That's the only way it differs, but otherwise it's not going to differ. The structure is almost always going to be consistent, right? And then now you start to take the figures and what you do, you drop them, right? So I will just do for the sales, for the VAT. All right, what was the closest? The closest one is the VAT input. So we just do an example for the VAT input, right? And then the VAT output, you guys can, we've already seen it, but you can just attest to yourself. Right, so we already have VAT input here. right? And the only thing that we need then is a description, because we already have this VAT input, but we just need a description. So from the cash receipts, what is an expense that we got when we were receiving cash? So obviously this is settlement discount granted, right? That reduced our income. And the description there is that it's coming from the trade receivables control. So if you come to your VAT input, then you have to say your trade receivables control. It's coming from the CRJ, and then this is the amount, right? So that was VAT. Then cash payments. We know that purchases column is VAT anyway, but then purchases is recorded exclusive of VAT. So the VAT input is 15% multiplied by that. And now we have the amount. We need to know the description. The description is cash payments journal. We are making a payment, right? So we credit the bank, we debit purchases, we debit VAT input. So we're gonna come and say bank here, right? From the cash payments journal, then that amount, whatever amount you get. Then we come here, purchases journal, trade payables column is inclusive. It's VAT input inclusive. So 15/115 multiplied by that. Right. Then you come to your purchases returns journal. That's VAT input again. And because it said the trade payables column, it's inclusive. So the VAT included there is that. Right. So eventually you construct your VAT input account the same way you constructed, we always do. Right. So basically, this was the concepts that we wanted to discuss with you. Right. We're gonna share this recording. So if you like to get the recording, we're gonna post it on YouTube. So also on our Telegram group. So if you do not have access to our Telegram group, you can join using this number. You just say you want to join. Then when you join the class, the group, then you can see the recording. It will be there. Then you can text you to YouTube. Then you can practice that.